Gold was on a free fall, the US dollar was bullish, and the British pound was under pressure until an unexpected tweet by President Trump shook markets and made investors reassess their positions. Well, President Trump said that attacks against Iran's power plants will be postponed in the next 5 days as talks between the two sides were constructive about a complete end of hostilities in the Middle East. Of course, confirmation remains by Iran, and it will be quite interesting to see whether the two sides will enter a new round of discussions. But in the meantime, let's have a look at whether the technical picture can justify a reversal in global markets. So let's have a first look at gold. While the precious metal faced an extremely strong downfall recently, losing almost 25% from all-time highs, but from a technical perspective, it found strong support near its 200-day moving average earlier today. It hit a 4-month low near this line, near 4,090. And that kind of increased questions about whether whether that downfall over here is about to end or whether it has already reached a bottom line. Well, looking at the technical picture, we can say that the market is indeed in oversold territory. The MACD is at extremely low levels. The stochastic oscillator is looking for an upturn from oversold region, and the RSI is also dipping into has also reached, it's also below its 30 oversold levels. So all the indicators down here can justify a potential rebound. Now, well, about the bullish outlook, I think we still have a couple of obstacles to overcome. The 4,470 could come first into view. But then beyond that, the 23.6% Fibonacci retracement level of this uplift that started in 2022 could also come under examination at 4,660. And then slightly higher than that, there is another obstacle near 4,785, which overlaps with this former resistance turned support trend line. Beyond that, the 20 and 50-day moving average could come next into view. The lines are currently between 4,960 and 5,023. So a decisive break above those lines might be necessary to bring back expectations for a bullish trend continuation, and perhaps, and more importantly, a break beyond this tentative resistance trend line could play a bigger role on whether the precious metal will resume its record rally. Now, on the downside, since there is no complete end to the Middle East crisis, downside pressures may also persist. So talks will probably continue. More headlines could emerge on the geopolitical front. But for sellers now, what would be quite interesting is whether the precious metal will fall below the 4,080 and 4,170 support territory, which coincides with a 38.2% Fibonacci retracement level of this uplift over here. If we fall to hold here and potentially break below the 3,930 and 3,990 zone, which was also as a key support zone back in October, then in this case we could see a bearish trend continuation towards the 50% Fibonacci of 3,600. Now looking at dollar yen, well, the US dollar was pushing for more gains earlier today, but as we can see, it remains constrained below last week's 21-month high of 159.89. The 159.70 more precisely has been a key resistance against upside pressures, and Trump's tweet has just pushed the price to the negative area today, so that increases the risk of more downside. Nevertheless, we cannot confirm this since the technical indicators are still in positive territory, so deeper declines are needed in order to push the bias back to the negative zone. Specifically, a break below 157.70 could activate a new round of selling towards the 50-day moving average at 156.50. Then below that, there are a couple of other support levels, such as the 155.50, 154.50 zone, which the price could test before heading towards that critical support trend line near 153. As we can see, the 200-day moving average is also approaching that zone. So that could be a key critical support zone to watch in the coming weeks. But let's see whether downside pressures will persist. We'll get more headlines from Fed policymakers later this week. Policymakers will probably discuss the case of steady interest rates and whether there's potential of higher borrowing cost in case inflation starts to trend up on the back of the Middle East crisis. And more data releases will be out, including the S&P Global Business PMIs out of the US. Now, in the event that the dollar regains power beyond 159.70, then the next resistance could emerge near 161.60. That coincides with this resistance trend line that connects previous highs from November and also January. And then the 2024 high, 162, might be also a key, could be also a key barrier against upside pressures. Finally, looking at pound dollar, well, the UK will be facing a busy week of data releases. The pair was in the negative zone until Trump's tweet hit the markets, reversing earlier losses. But what is striking here is that the price is faced another rejection near the 200-day moving average. That line has been blocking upside pressures over the past couple of weeks. And as we can see, the price is still struggling to rise above that line and also overcome this resistance trend line near 1.3440. So for a bullish breakout, I would like to see a clear close above that, and then probably a clear move above 1.3490, where the 50-day moving average is placed, could actually brighten the short-term outlook, bringing the 1.3555, which overlaps with the 38.2% Fibonacci retracement level of this uplift. So any close beyond that may trigger a faster increase toward the 23.6% Fibonacci of 1.3665. However, looking at the technical indicators down here, we don't have a clear picture yet. The RSI is still below 50, the stochastic oscillator is still pointing to the downside, and the MACD is in the negative zone, so we don't have a clear bullish sign, and that reflects caution over the Middle East crisis, as we still don't have any clear sign that the crisis in the Middle East is about to end. Perhaps today's news the latest headlines, positive headlines about Iran may keep the price supported, but if the price fails to close above 1.3335 and beyond its 20-day moving average, we could see a reversal back to 1.32, where the 78.6% Fibonacci mark is located, and then beyond, and then lower than that, the 1.31 and 1.3130, which seems to be part of this support trend all over here, could next come to the pair's rescue, blocking any additional declines towards the 1.30 floor from November 2025. So we'll probably get more volatility in this market as UK CPI inflation, retail sales, and business PMI figures will be out of the UK at the time when the central bank is thinking whether steady interest rates for longer are more necessary. There are also expectations for higher interest rates as reflected in futures markets. So obviously the data could be a key source of volatility for pound dollar. But it probably requires probably a complete resolution of the geopolitical risks in the Middle East in order to see a nice bullish reversal in these markets. So that's all from me. Thank you for watching. We'll be here with more technical analysis on Thursday. So it's a goodbye for me for now. We'll be back soon for more market analysis. Thank you for watching and see you next time. Bye bye for now.